G'day all and welcome to today's webinar. My name's James Gerish. I'm going to be joined shortly by Sean Hickman for today's Market Matters webinar. We've titled it our positioning into or for FY26. So can't believe it, but we're only a month or so away from a new financial year, and a huge amount of things have gone on in markets. So we're going to discuss some of those today. But today's webinar is going to get pretty sharp in terms of looking at some stocks we're thinking of doing things on or have recently done things towards. So we'll give you a rundown of our thoughts around a number of our positions and stocks out there. We'll give you a quick overview of what we think from a broader picture on the market. And it's wonderful to have so many of you on the line today, whether you're Market Matters members, thanks for being so. We've been going 10 odd years now and producing content every day, producing a digital advice site that has a lot of information. I'm going to take you through some of that today. I'll bring you in, Sean, to say hi. I hope you're well, mate.
Morning, James. Nice to see you.
There you
good
are.
Good afternoon, I should say.
Mate, good afternoon. Yeah, it's been one of those mornings which has been hectic. Haven't had a spare 2 minutes, but such is life at the moment. I'll give you a quick run through of a overview of Sean and I, for those that don't know. So we've both had plenty of experience in markets, 20 to 30 years experience in different trading and investing roles. We're central behind the Market Matters investment team and research team. So we're charged with writing the majority of our content, presenting our views on the market and managing the Market Matters portfolios. Of course, we're supported by a broader team, and that is the Market Matters business in a nutshell. Disclaimer before we begin, just that today's webinars are a general information only, and it doesn't take into consideration any person's personal circumstances. So general information only. Quick overview of our investment process. I do this at the start of each webinar. We call ourselves top-down meets bottom-up investors, and what we mean by that is we do take into consideration top-level macroeconomic analysis. We then form views around sectors and then dig into stock selection and portfolio construction on the back of that. What we're all about is delivering information in a clear, concise way, having views on the market and having those views backed up by research. And I hope you get the sense of that when we go through today's presentation in terms of both what we're discussing, but also the depth of information, data, analytics on the Market Matters website and how it's presented to our members. So today, Sean, run through us what we're going to cover.
Okay, we're going to start off. We're going to look at the tariffs and where we see the market here now, moving into FY26. It's amazing to think it was only in April where everyone thought the world was falling apart. Here we are today, 2.5% off of all-time highs. It's almost like April didn't exist. Then we're going to look at, there's a thematic coming through. We've discussed it a few times in reports. We're going to cover that today. 3 stocks we like, 3 stocks we're becoming more cautious on as we see that transition unfolding. And it might not unfold until next financial year. Markets have a tendency to like to run their winners and cut their losers into the end of financial year, but it's certainly where we're starting to focus on moving forward. And then the last thing we'll look at is the macro red flags, what we should be worried about. You know, obviously, if this market's going to kick on towards 8,800 or 9,000 or whatever number it might be, there will be a point in time where we have to evaluate the risk reward again and say, well, hang on, if bond yields are doing this or the dollar's doing that, where is the risk reward good? We were very comfortable with the risk reward when the market plunged in April. Getting back towards all-time highs, we have to be a bit more open-minded, pragmatic, and choose stocks accordingly.
Perfect. And just starting on tariffs, we don't want to spend too much time here, but one of the ways we've phrased or talked about tariffs during the recent meltdown in equities and a lot of asset classes around the world is whether or not tariffs were a policy or a strategy. Tariffs as a policy don't work. So obviously protectionism is a mechanism that has been put to one side for a lot of years now. Trump was trying to bring that back, but we find it hard to comprehend that his campaign focused on or why he's been elected the US president was all around improving living standards. So tariffs ultimately push up the costs of goods in the US and reduces people's living standards. So the way that it was enacted was also quite strange, quite extraordinary in the way that it was rolled out from a global context. And that obviously had some impact on markets, and we saw equities plunge 20% when they were rolled out post-Liberation Day. So we elected to view tariffs as a strategy, a negotiating strategy, and I think that's how we're starting to see it play out from now. There's been a huge change in rhetoric around how tariffs will be applied, the rate they will be applied on, and the deals that will be done with different trading partners of the US. So policy or strategy, we suggested it was a strategy at the time rather than a policy, and that started to bear fruit in terms of how we're positioned in markets. But markets were pricing a lot of unknowns, and I think there is still unknowns. And one of the things that we've seen in terms of markets is that investors have been really focused on certainty. So because if there's a huge amount of uncertainty in the economic backdrop, the macro backdrop around trade and growth and so on and so forth, then investors have started to gravitate more towards those companies that provide certainty at the company level. And there's some examples we'll get onto very shortly that really highlight that thematic. And then we'll think about the longer term implications of trade, the trade policy. So there will be some longer term implications for that. Tariffs will be applied to other trading nations. They will pay more, and ultimately the price of goods will go up over time. And that has implications for things like long-term inflation expectations, interest rates, and so on and so forth. So we'll go over those three specific areas as we talk through stocks in today's update. Just on the screen there, before I jump onto the Market Matters website, and I'm going to do that, I think I was going to go through a presentation, but we'll jump onto the Market Matters website instead. Chart of the ASX 200 on the screen there, Sean. Obviously, we write about this on a daily basis. It looks fairly bullish to me. You're on mute there, mate.
There we go. I mentioned some numbers before, 8,800, 9,000. Obviously, by definition, I'm just pulling those from left field, but I think we've been saying for a while, it's a matter of time till we see new all-time highs. There's plenty of markets there already, the German DAX, the Canadian market. Ironically, the Canadian market, one of the focuses of Donald Trump, is now trading at all-time highs. CBA, all-time highs yesterday, all-time highs today. You know, there's plenty of reasons why we have to say, okay, this market's going to make new all-time highs. Yes, it's bullish. How far it goes, that's guesswork. But until further notice, I think this market's going up.
And I think the way there's 4 points there I've used to summarise our view. So we've put the tariff shock is done. So I'm not saying tariffs are done, but the tariff shock is done, and markets have digested that. We've seen that play out over the past month or so. Interest rates are going down. So the RBA came out yesterday and cut interest rates as everyone was expecting. But what wasn't perhaps expected was the more dovish tone. Michelle Bullock in the press conference after the decision to cut rates was, in my view, significantly more dovish than the market had expected. What we mean by that is that she's basically saying that inflation is now under control, whatever way you look at it, whether it's the headline number or the trim mean, it's back within the target band. And if you look at the RBA forecasting, it's going to stay in that RBA band under their forecasting scenarios. They downgraded growth expectations, but not by a lot, 2.4 down to 2.1. That's sort of a good level of growth. That has had a huge, I guess, positive impact on the market. But tying in what we talked about just before around investors gravitating to certainty in stocks, and we understand why, it's been at the expense of the more value-orientated names, perhaps names that have had warts on them. Something has gone wrong with them to make them cheap. And that's probably the area of the market that we're now hunting in. So more certainty from a macro level will lead to some mean reversion from stocks that have provided that certainty for investors into those other areas that are representing value. And I say this is where we are hunting at the moment, and we're going to lead you through some of the ideas that we've got. The next chart just demonstrates this from a practical sense. So we're not saying the companies on the left are bad companies and the companies are on the right are good companies. It's probably the other way around, but it's very, very, very much in the price. So we've got a top tier retailer, JB Hi-Fi, trading on 25 times. Last update they provide, their sales, like-for-like sales, are up 6% in the quarter. Super Retail has had a bunch of issues from a company specific point of view. They don't have the tailwinds around technology that JB Hi-Fi and the refreshing of technology that JB Hi-Fi do, but they're growing like for like at 4.5%. JB's on 25 times, Super Retail's on 14 times. So it shows you how much the market has bid up that certainty theme. Is JB Hi-Fi worth 10, 11 PE points more than Super Retail? We wouldn't think so. We own Super Retail. We don't own JB Hi-Fi. CBA versus ANZ, clearly a great example. CBA is trading $176, and there's a huge amount of bank bashing in terms of CBA's well and truly overvalued. They've got growth about 3.5% at the earnings line expected over the next 3 years, and they trade on 27 times. ANZ's got growth of about 1%. They're integrating Suncorp's banking division. They've got a bunch of other things going through. They've got a new CEO. There's a lot of reasons why there's probably a little bit more risk in ANZ, but they're on 12.6 times earnings. Now, we own CBA in our income portfolio, and we also own ANZ. But again, it's an explanation of this huge trend where investors have pushed value to what we think are extremes. And then looking at Dalrymple Bay Infrastructure. So this is a company we also own in our income portfolio. It's done really well for us. It has it's a really defensive coal terminal up north, very consistent earnings. They operate on take or pay contracts, so volumes go through, or they get paid for volumes no matter if volumes go through or not. They've got growth of about 5%. They're out with some news today saying they're increasing their infrastructure service charges by 3.6% for FY26, but they're on 21 times, whereas Whitehaven Coal has been kicked to the curb. According to consensus numbers, you average the 3-year growth rate, and we're going to get nearly 20% a year, and it's on a PE of 15 times, and it's been really unloved by the market. So not to say one side are bad, one side are good, but it's to demonstrate the huge amount of money that's gone into this certainty trade versus the, I guess, less certain trade, which is often screaming a lot better value. Anything to add there, Sean?
No, not at all. I mean, I think that's exactly, and as I alluded to before, it will be very interesting to see when the market decides to tell us that it wants to go in looking at the stocks, as you put it, that have got warts on. Not happening quite yet, but I think it will happen.
Yeah. All righty. So you should be seeing the Market Matters website there. This is your dashboard. The first port of call when you go and log into the Market Matters website. It details a bunch of things. That's my hit list there. It's got latest viewpoints. So they're the stocks we've most recently covered. Some videos you get to understand. We do a morning podcast and a midday podcast that's on there. Jeff Wilson regaling us around the WAM income maximizer and a bunch of other things. You can go down into the portfolios that we have. So we've got 5 portfolios there on the Market Matters website, 6 portfolios there on the website, and you can go in and dig into those, and we'll do that today. But first I wanted to get into some of the stock calls. So basically we've titled this because I want to leave some time for questions. It was around providing 3 buys that we're thinking of. We've either bought, we either own, or we like here, and then 3 stocks that sort of demonstrate our views around moving potentially away from the certainty trade and looking more towards value in the market. And we think that's our roadmap as we go into FY26, given the bullish backdrop. I'm going to bring the first call we're going to make is WiseTech, and we actually bought this one yesterday. If you want to search any stocks, you can do by stock code at the top of the website, or you can search by name at the in the panel at the top as well. So this will bring you to a company page, Sean, and why don't you kick off, and I'll for a quick overview of WiseTech, and I'll come in over the top of you.
Correct me if need be. Okay, so WiseTech is a company that's got a lot of bad publicity over the last, say, 6 months. Richard White is a brilliant CEO and founder of the company. He helped build it up to what it was today, what it was 6 months ago, and still what it is today, a multi-billion-dollar top-rate logistics company. But there's been some issues with the business, with his personal life, etc., that's caused governance issues. It's caused some of their fund managers, by definition, to step aside or reduce their holdings, and it's created a lot of uncertainty. But we have to stand back and look at the business model. We got to stand back and look at the value and the opportunity. This was an incredibly loved stock. We can see from the chart there, going into the start of the year, it was a very, very much loved stock. And it was one of those stocks which we hadn't owned and were hoping to own, hoping for weakness to buy into. Well, we've certainly had that weakness. And what we're really saying here is we feel that WiseTech is going to put their head down and go ahead as business as usual, and basically show investors that this is a world-class company. It's got very, very sticky clients.
That's the key, right? So
yep.
That's the key in my view. So just to take a step back for a sec. So these guys have a cloud-based logistics platform that handles things from logistics to supply chains, etc. So we all understand how global trade has moved. It's pretty complex. So you think about freight forwarding, customs, warehousing, transport. All of those things are quite complex. So WiseTech has created a platform that integrates all these different things into a cloud-based solution. It's called the head operating system is called CargoWise. And basically, to Sean's point, it's all about having this complete package that you ingrain it into the supply chain. And that's why they've made a lot of acquisitions over the years. And they're thinking about another acquisition at the moment, about $3.5 billion acquisition, so pretty large, over in the US, to another platform that would help them expand and ingrain their operation into the overall supply chain. So to me, it's a play on a couple of things. Complexity in supply chains, they're going up, and it's also a play on global trade, so more global trade. So it's definitely a growth company, growth stock. There's no two ways about that. You can, if you want to go and look at forecasts and things on the Market Matters website, you can. So if you go down to forecasts, you can generate a quantitative stock report there, which is pretty interesting. But you can come down and look at revenue growth forecasts, net income as net profit after tax forecasts, and come and look at what analysts are expecting on a stock like that. You can jump into our opinion and look at every time we've written about WiseTech. And you can jump into our actions around what we've been doing on the stock. It's a $34 billion business.
Sorry, James, I don't want to interrupt there, but I just want to make a very quick point. I ask this question every week. Those forecasts are consensus forecasts. If you want to have a better idea of what Market Matters think, that is when you go into the opinion section. But those forecasts are the consensus forecasts. So
we're not producing our own forecasts, so financial forecasts. So analysts produce forecasts. So we've got, we rely on other analysts. Consensus is an aggregation of all of those forecasts to get the average number, and we create our written content and form our views, etc., on the back of that. In terms of Richard White, and you made mention of Richard White, clearly a heap of indiscretions, and I don't want to downplay that, but just like the logistics supply chains are really complicated, WiseTech's a pretty complicated business. So someone who's built it from the ground up, who really understands it, and who is now really focused on the business. I know it's not a popular thing that he's back in the business from the optics point of view, but from a operating point of view, from a financial point of view for this business, is really important. And the fact that, I don't know how he's done it, but he's manufactured the executive chairman role, and obviously he owns 37% of the business, so he's a major shareholder in it. That's where the majority of his wealth is tied up in it. And I think from a growth standpoint, this is going to be a phenomenal growth story in the next few years. So WiseTech, we've just recently bought it, and that's our first buy in today's webinar. Our next one, Sean, I'm going to give you a quick rundown of this. I'm not sure if you're too across SiteMinder.
A little bit, but I'll let you shoot.
So this is a hotels hospitality business, very similar to what WiseTech is doing in the logistics supply chain area. These guys are doing it in the hotel space. I'm just going to zoom out to give you an idea of the longer term trends, because this was listed back in, I think it was November of 2021. SiteMinder was listed. Hottest IPO of the year. Macquarie with a listing broker. You couldn't get stock. It really ran hard on open of this listing, and then it's been a little bit challenging since. So it's not a small business. It's a $1.2 billion market cap company. So we do have this in our emerging companies portfolio, and we've added to our position today. They do things like channel managing of hotel bookings. They do platform optimization, so directing things to directing hotel bookings through other sites and managing the aggregation of Expedia, Booking.com, Airbnb, etc. They tell a hotel how they should be pricing their rooms based on data. They have a platform to effectively run a hotel. They've got like 40, I think last update, it was nearly 50,000 hotels globally use them, about 150 countries, I should say. So that this is a big business, but it's not a profitable business. It is soon going to be profitable, and that to me is going to be the tipping point for SiteMinder to get re-rated in terms of share price. And that's why we like it here, Sean.
No, I mean, you've covered most of the points. I'd actually made a few notes, James, so I would have covered most of those. But I think the key is, I think it's going to lose about $15 million this year. Not a huge amount of money for a $1.2 billion company, but the key is all of the non-profitable tech companies in the US have been thrown in the naughty corner, as a phrase that we often write about in reports. If we get this change in sentiment, which we believe is going to happen over the coming months, this is where people are going to start to go shopping for value, because they can't keep chasing stocks like CBA at 190, 200, 250. At some point in time, great companies have got a fair value, or they're just simply too expensive. And they will look at companies like this, and they will, as James said, they will look at what it's going to be doing in 1, 2, 3 years' time and say, well, hang on, it's losing money today, but it looks fantastic in 3 years' time. And you'll get valuation they'll be revalued, simple as that, and the upside is very, very high.
All right, so we like SiteMinder. We think it's been hit for a couple of reasons. It's right across the travel space. So we've seen corporate travel come out with a downgrade recently. US weakness to blame. We've seen Flight Centre come out and recut their numbers lower. But what we've seen after that fact is they come out with a downgrade, which the market is really, I guess, preempting, ready for, and that clears the decks for things to improve. So obviously it relies on travel continuing to remain robust, and then getting to break even whilst continuing to grow quite strongly. So it is at the higher end risk spectrum of our investing universe. There's no doubt about that, but it is a meaningful company. If I look at one of the other things, you can go on the Market Matters website and look at. You can see what brokers think of it. So there's 12 buys on this stock, and 2 holds. So consensus forecasts are well above the current share price. Target price consensus of $6.02 versus current share price of $4.80. 40. All right, so that's SiteMinder, SDR. We like that one. We like WiseTech. And then this is a bit more of a boring one, Sean, to cover off on. We're not looking for all growth stocks. We're not looking for all edgy stocks. We often look for value orientated stocks. And this is one I touched on just before. Super Retail.
No, absolutely. There's a few moving parts in super retail. One of the ones that's been getting a lot of airtime of late, obviously, is Rebel Sports, with phrases from the UK coming over or making noises about coming over and competing and potentially compressing margins for Rebel Sport. But that's what creates opportunity.
And Rebel's been a big winner for them. Rebel's been one of their strongest areas.
And last year it was 33% of revenue. So it's a really big, strong part. But it's going to take a long time, years and years, for phrases to come in and make a dent, in my opinion. And this, the selling that's come into super retail, the fact that you've got the opportunity to get into these levels. And we saw a result, the latest result was okay, but the stock rallied on the back of it. And I think that's telling you that the market's got itself too pessimistic towards stocks like super retail, probably too optimistic towards JB Hi-Fi, as we touched on earlier. This trend isn't going to change overnight, but we feel this is where the value is, and the value proposition. At some stage, they're going to turn the page in the book, and this is where we feel you'd want to be sitting.
The way I think about super retail is like JB Hi-Fi has obviously got two main brands, JB Hi-Fi and the Good Guys. Good Guys are struggling a bit. JB Hi-Fi is the jewel in their crown. Super retail's got a bunch of, I guess, semi-uncorrelated brands. So they've got obviously Super Cheap Auto, they've got Rebel Sport, they've got Macpac, which is very much exposed over in the US, New Zealand outdoor market. They've got BCF. BCF was actually the one that really creamed it in the last period. Macpac was the weaker side of their operation. But you think about, so they've got a collection of good brands. Some will be working at some time, some won't be working at others. They're trading it on reasonable valuation. They're trading on 14 times for the level of growth they've got. So they've got growth of sort of mid-single digit earnings growth. They've got an okay yield. Yield is 5.6% at the moment. You can see this in terms of, this is the current yield, but forward yield in terms of super retail is about 5.6% fully franked. So you're getting reasonable value, reasonable growth, diversified business model at a reasonable valuation. So a portfolio needs to be a collection of all different sorts of businesses at differing weights to achieve a particular outcome. And I think super retail is one of those that marries up quite nicely now. A combination of some growth, some valuation support, and some yield.
Exactly, and of course, let's not forget the fact that it's a stock that should be well supported by the rate cuts that are coming through.
Yeah, I mean, we can't underestimate that, and I just like. It seems very clear to me that the RBA is going to cut rates now quite aggressively. They've opened the door for it. The rhetoric on, in the press conference after the announcement, there was a clear change of tack rhetoric from Michelle Bullock. So I think the market's pricing that, and that's why we're seeing such a bullish day in the market today. We're up about 80 points, I think, at the moment. Sean, I don't have it in front of me, but which is well and truly outpacing what other global markets did
exactly.
overnight. We're running our own race.
We're up 60 there, James, but we're still above 8,400. It's a huge change in stance, far more dovish than I thought she would be. I think if you listen to what she said, there was a phrase we used in the morning report today. Don't fight the Fed is what always gets quoted. Well, now it's don't fight the RBA. I think there's a very good chance we get 3 cuts before Christmas. It's not rocket science. That's basically what Michelle Bullock said. That's what they're going to do, and that's the goalpost move.
You can go and see there's on the front page of the MM website. You can see like there's different ETFs. So the A200 ETF is there, and you can chart these different things. So you can look at the 200 stocks, the small caps, S&P 500 ETF, which is trading in our time zone, etc., as well as a bunch of other things. We've got Catapult down here, which actually came out with a good update today, a cracking update. They've had just the They've had records right across the park, and this is just an aside. Cat wasn't a stock that we're going to talk about today, but he's trading at all-time highs, trading on the way to $5. We've written about this stock in the last little while, but this is a stock that's like how I mentioned in terms of SiteMinder, when a company like this scales, and then you get the operating leverage in the business. So obviously revenue on scale, their margins improve, and it really drives strong operational leverage in the business. Xero is probably the pin-up child of that, but Cat's certainly on the way there. I think they're 31. They're at 31 in terms of achieving their Rule of 40 ambitions, which I think is really really strong. Anyway, that was an aside in terms of Catapult, a stock we own, trading very well today, up about 11 to 13%. It was 13% when I left the desk. APA Group, Sean, we're going to move on to things that we're less keen on now. So less keen on in terms of APA.
Yeah, I mean, APA is a company we've been very, very keen on for a while. And I think it's as opposed to less keen on, I think it's more a case of it's done a lot of its dash is probably where I would call it.
It's a good way to frame it.
Yeah, it recently got up to about 870. It's had a good pullback to about 820, give or take, because people like myself thought that the RBA would probably only cut twice this year. Now it looks like there'll be 3 times or more. So it has got that support of a very, very strong yield. It's about, give or take, 7%. That's a huge yield. And from a stable point of view, it looks like it's going to still, I wouldn't call it next.
Be supported, but it's not going to, yeah.
Yeah, that's exactly the phrase I was looking for, but couldn't find. Very well supported.
We were talking about it earlier this week, Sean and I, on the desk, and just talking about it from a growth point of view versus a yield point of view. So growth in terms of share price. So we've got APA Group in our active growth portfolio as well as our active income portfolio. So rewind the tape a couple of months ago. It was being sold off pretty aggressively because there was this expectation that they, or fear that they couldn't fund their growth pipeline, and they will come equity raise. They reported and they allayed those fears. They said they would not be raising equity and they could fund their pipeline of development. That caused a big re-rating on the stock, and then you see overlaid by this move into certainty at the expense of cyclical type companies that have less certainty. And APA Group has had a really strong bounce from $6.60 up to $8.40. So it's had a strong bounce. If we're thinking about growth, what comes next in terms of growth, then I think this is one that we probably wouldn't be buying here in terms of growth, and it's probably one that's nearer the exit of our growth portfolio, but it's likely to remain in our income portfolio, given the outlook for growth, I think, has probably gotten a little bit more muted after the share price has bounced.
Exactly. It's done what we were looking for. I'd rather hold APA than cash. At the end of the day, if the market's going to be strong like it is today, APA is up 2%. It's going to benefit from the rate cuts.
Well,
so it's better than cash, but it's not necessarily better than other stocks.
That's the thing, right? So there's some competing factors at play. It's obviously been bid up because the certainty trade has attracted a lot of money, but now they're cutting rates more aggressively. APA is considered like a bond-like equity. So when you get this, bonds have been bid up on the back of this changing rhetoric from the RBA, pushing yields lower. So bond prices moving up. APA Group is highly correlated to bond prices. So there's some swings and roundabouts in APA, but at the end of the day, I think from a growth point of view would be, I wouldn't, subscribers and members shouldn't be surprised if we do exit this one in our growth portfolio in favour of something else. DBI, exactly. I spoke about this one earlier, but it's again one that we're nearer the exits on. We have this one in our income portfolio. It's done phenomenally well for us, so it's done phenomenally well for us. My computer has just frozen. I'm in need of a new laptop. Okay, so anything to add before because I'll update listeners on what they came out with today.
No, I mean, again, unlike APA, this is only yielding around 3.5% because it's had such a
No,
huge move.
Yep. Yeah, no,
But
it's about a 6% yield. Yeah, you'd be looking historically.
okay, yeah, I stand corrected. So, it's as you say, it's had a huge move. It's in the income portfolio. What do you replace it with at some point in time? There will be something better.
Yeah, it's a tough one. So I continue to like it. They came out basically the premise we bought this stock and we've owned it. We're up 30% on the stock from memory. We've owned it for a little while. The reason why we bought it is they came out and basically guided to increasing that's priced off its yield. So they've guided to an increase in yield in the low to mid single digits. They've come out and this morning and provided guidance for their dividend for FY26. The dividend's going to be 24.5 cents, up from 23 cents. So 1.5 cents. That's about a 6% odd increase on FY25 numbers. So to me, that is a strong dividend paying stock with a very strong earnings stream. So in terms of their earnings, the infrastructure surcharge there, or increase in infrastructure surcharge they're putting through for the coal miners because they export coal through their terminal. I think it was up about $3.70 per tonne, which is about a 3.6% increase year on year. So they increase their earnings, they increase their dividends, and it's a really stable earnings stream. So whilst on 21 times, I think it's fully priced here. There's no catalyst to sell. But if you think about positioning a portfolio more towards a cyclical rebound, then DBI is one that's been this security type position that's really been bid up on this movement in market. So that's on that to us is also on the chopping block, and we're assessing that. I don't think we'll move it on any time, imminently, but it's certainly on the block.
Yeah, it's a potential funding vehicle.
It's a good way to put it. Okay, in terms of the final stock that would be, and we're trying to use stocks that show a particular theme. So stocks that within a sector have potentially one's really outpaced another one, and we're looking more towards fading that move as opposed to going with that move. One of those is SRG Global. So SRG is for those not familiar with it, it is a engineering services company. They do infrastructure maintenance. They do things like mining services. It's a business that's done really well. It's not a small business. It's about an $900 million market cap from memory. They have about 4,000 odd employees. They do about $1 billion worth of work, or a bit more actually. It's about 1.1 billion now. So this is a substantial business that's done really well, and we hold this in our emerging companies portfolio. We've flagged it today because these businesses are notorious in terms of they're tough businesses. So they're lots of staff. There are lots of complexity. We know in our Market Matters business about the complexity of staff, Sean. And we have and they operate on pretty slim margins. We own another business in this area called Worley, which is a lot bigger. They're moving more into sustainability work to try and improve their margins and so on and so forth. But SRG on 21 times is expensive for the type of business they are.
Exactly, and it's what are we, 2 cents, 3 cents this morning below all-time highs.
It's smack on its all-time highs, yeah. So yeah.
It's to me, it's run its race, and I wouldn't be surprised again if we use that as a funding vehicle going forward.
So then you think about, so it's on 21 times, and we made the point before about looking at companies with a few warts, and this is certainly a company with a few warts. So is NRW Holdings. So they've got some issues with the Whyalla steel mill and the amount of money they're owed in terms of that. But NWH is a similar sort of mining services company, engineering company operating around the country, and it's trading on 10.7 times. It's whenever you're going to look at a stock that's been hit hard, and he's screening really good value, there's going to be negative things to think about in terms of a stock like that. But they have very similar. It's the challenges in this business are really similar to the challenges in SRG. SRG have been executing really well. NWH have been executing in a lot of parts of their business, but some parts of their business have had issues. So to me, I'd be more keen to look at NWH over and above SRG at this point in time. I'd rather pay half the multiple, get a 6% dividend yield in NWH rather than SRG. In saying that, we own SRG. So that this is a company we have trimmed it once, and we're likely to trim it again or exit that position. And we're flagging things that stocks that we've got skin in the game, stocks we own. Personally, I've got all liquid wealth in the Market Matters portfolio. So we're talking about what we're doing in the markets as opposed to being theoretical like some others out there. So these are the things that the conversations we have around investing our own money and how we're positioning our own portfolios, our portfolios of clients, and the portfolios that we're writing about and covering on the Market Matters website. So just to wrap up, so we talked about the macro backdrop, tariffs. We think we're a strategy rather than a policy. As a policy, they don't work, so they must be a strategy. We talked about interest rates here locally. So obviously the RBA cut interest rates, but they've turned a lot more dovish in terms of their guidance moving forward, inflation under control, slight tweak lower in terms of growth. But this is overlaid by commentary from Michelle Bullock around the strength of the Australian economy. The economy is still holding up relatively well. So you got lower rates meeting an economy that's holding up pretty well at this stage. Things could change, but at this stage it's holding up very well. We then went through 3 stocks we'd be happy to buy here and now. The first one was WiseTech. The second one was SiteMinder, SDR. WiseTech is WTC. And the third one was Super Retail Group, which is SUL. And then we flagged 3 stocks that we're more on the side of selling. And incidentally, we own all 3 of them still. We've got APA Group. We're looking at levels that we'd reduce our exposure or potentially sell that for our growth portfolio. We've got the level that we would, spoke about DBI as a potential funding vehicle and income portfolio. And we've used SRG to highlight the variance within an individual sector of companies that have been executing and those that haven't, and the big PE discount that the ones that haven't are now trading on. I think that's a theme that I'll end with. So we're thinking about the stocks that have done phenomenally well. Great to have them, but we now need to be thinking about the stocks that have lagged and look through the warts, the reasons why they've lagged as money moves down the risk spectrum or up the risk spectrum, as we say. Anything else to add, Sean? There's a couple of questions here which I'll get to.
No, I just want to reiterate, if we get that blow off to new all-time highs, historically, what tends to lead that is people going in search of value. So at some point in time, if we're going to do a classic chapter, which we've seen time and time again over the years, what we're looking for has played out in the past. It's not like we're trying to reinvent the wheel here.
All righty, so we've got a few questions here. So Peter's talking about CAT today, gangbusters. Yep. Indeed, Peter, we're enjoying that one. Doug's asking about coal stocks, Whitehaven, Yancoal. We like coal stocks. We've liked them for a while. We've been wrong in the short term. We're down a little bit on our Whitehaven coal position. We're about flat on our New Hope coal position in the income portfolio. We have Whitehaven in the growth portfolio. We continue to think that the coal market will turn. We think it's base. So coal prices have bottomed out. They've started to edge higher, but we're still bullish on the coal trade. What's your current view on Pro Medicus from Rodney? Great stock, bounced hard. Sean tried to buy it. I talked him out of it, and that's where we're at the moment.
I wasn't going to mention that, James. My son bought it. So anyway, he made some money. But on a more serious note, I would not be chasing it at 285. It's one of those stocks that it is a really, really hugely high beta stock. Do I think it goes up? Do I think it goes above $300? Yes, I would. Yes, I do. I wouldn't chase it here.
I think the reason why I was a bit cautious on PME is basically the requirement for them to continue winning contracts to support their valuation. So you think about what was playing out in the market at the time, winning contracts in a market that's really uncertain. We've seen it in a lot of areas where corporates just hold up their hands and don't want to do anything in the environment where there's a lot of uncertainty. They don't want to sign any contracts. They don't want to spend any additional money. That was my concern on Pro Medicus, and I put my hand up and say completely wrong on it. I'll be hearing about that for quite a while from Sean.
I think I just mentioned, James, that's a good example about how the fact that we weigh up these things together as a team, and Market Matters and the rest of our people in Market Matters before we come out with decisions. They're not just one person pulling something out of the air.
Yeah, which happens to a lot of our competitors, I think. Anyway, given your recommendation on SiteMinder in the travel tech space, what are your thoughts on the travel sector, in particular Flight Centre? This is from Beverly. So Beverly, read our morning report today. We've covered Flight Centre as a stock of interest. So Flight Centre came out with a weaker than expected update not long ago, but they're cheap, and we think there is going to be a likely turnaround in travel. So we actually quite like Flight Centre, and there's more info if you go in. I'll even do it for you here. So if you go in and you can either look at the morning report today, or you can go straight to the Flight Centre page. So what the website does, it strips out all of the different pieces of content from a morning report, and then goes and posts it on the individual company that we've spoken about. So this was the note on Flight Centre this morning in the AM report. It gives a chart, our view, an action. We're cautiously bullish, and then you can add it to your hit list or not. When you can go in and dig into the financials, dig into our past opinions on Flight Centre, and make a decision from there. So hopefully that answers your question.
I'll put a throwaway comment in there as well, James. A friend of mine, they work at Flight Centre. They said they've never been so busy. The only thing is people are going to different destinations. Everyone wants to go to Japan. No one wants to go to America. But the people are still spending money. They're still traveling. I'm not sure what Flight Centre's margins are between Japan and America, but I'd imagine they're the same.
All righty, nice one. All right, I'm going to leave it there. So thank you very much for all our wonderful members who have jumped on the line today. Great to have so many of you on board for this month's Market Matters video update. If you haven't checked out the website and you're a member, there's a lot of info on there that you may want to use. If you're thinking about joining, we encourage you to do so. We're going into end of financial year, so there'll be some information coming through in your inbox with interesting offers and so forth for us to try and entice you into the Market Matters family. So thanks again for joining us. Thank you, Sean. I'll see you tomorrow, and bye for now. Thanks, guys.
See ya.